The dollar is ripping higher, and if you think that's a boring currency headline, you're missing the fuse burning under everything you care about. When the dollar surges, risk doesn't just reprice, it suffocates. Emerging markets gasp first. Commodities stumble. Corporate earnings wobble. Crypto bleeds. Then credit spreads widen. Deal flow stalls, and the jobs people thought were safe get paused. If you own a house, carry a credit card, run a small business, hold stocks or crypto, what the dollar does next is not an abstract chart, it's your cost of living, your cash flow, your timeline to financial independence. Tonight I'm going to show you why the dollar's spike is not a victory lap, it's a siren. I'll walk you through the signals that flash before things break, the myth that keeps getting investors wrecked, and exactly what I'm watching in the next few weeks to separate a pullback from a full-blown funding squeeze. The flip nobody priced. Most people came into this cycle chanting dollar debasement like it was gravity. Print money, dollar dies. Assets moon. That worked as a story, right up until the dollar stopped listening. Bitcoin slid, altcoins got body checked, and even big liquid currencies flinched. The yen started making those pre-intervention noises we've heard every time Japan leans over the console and hovers a finger over the stabilize button. The rupee? Quiet on the surface, but only because the central bank's been bailing water to keep it that way. The euro rolled over months ago, long before most people noticed, silently feeding strength into the most watched dollar index, and somewhere between the headlines and the hopium, a lot of investors missed the more important truth. A rising dollar is not a USA #1 chant. It's the oxygen leaving the room. What the strong dollar actually signals and why that matters. Think of global finance like a skyscraper with hidden plumbing. The euro-dollar system, yes, that term sounds academic, is simply the shadow plumbing that moves dollar credit through offshore banks and balance sheets. It's not about paper cash. It's about who can borrow dollar funding, at what terms, and how easily the pipes carry it. When conditions tighten in that plumbing, two things happen. Risk appetite shrinks, and the dollar's exchange rate rises. Not because America suddenly became perfect, but because lenders worldwide get more selective, hoard the safest collateral, and demand dollars back. Prices adjust fast, balance sheets adjust slowly, markets panic immediately. That's depression economics in one line. Not 1930s breadlines, but persistent demand for safe, liquid instruments, while risk assets ride a mechanical bull. The myth that keeps blowing people up? Every cycle someone dusts off the fiat doom speech. Governments spend too much, therefore the currency must die. But markets don't run on speeches. They run on balance sheets. The reason debasement calls have been so consistently wrong about the timing is simple. They confuse the printer with the pipes. Central banks can expand reserves, and governments can issue debt, but the risk engine is the banking system's willingness to extend dollar credit. When that willingness fades, even a little dollar scarcity trumps theory. If you've ever watched a beach as the tide sucks out hard before a wave, you know the feeling. The water looks like it's disappearing. It isn't. It's winding up energy. A surging dollar often means the tide is running out from risk before the next set hits. How this shows up in the real world, and your wallet. Start with corporate earnings. A strong dollar makes U.S. multinationals' foreign revenues look smaller when translated back home, pressuring margins just when financing costs are already pinching. For commodity exporters and emerging markets that borrowed in dollars, the math is uglier. Revenues, local, debts, dollar. Each notch higher in the dollar is an invisible rate hike. That's why when the greenback sprints, we start hearing phrases like policy support, temporary measures, and liquidity operations in faraway press releases. You don't need to trade FX to feel it. Your company delays that expansion. Your supplier tightens payment terms. Your adjustable rate debt creeps up. The risk assets you love get mechanically cheaper because the funding that floats them got more expensive. The telltale canaries, yen, rupee, and friends. Watch the yen. When it weakens beyond what rate differentials justify, it's often not about carry trades or one central bank being dovish. It's the plumbing saying, conditions are tightening beneath the surface. Watch the rupee. If it's curiously calm while peers slide, that can be a sign of heavy official defense. And defense is a story you usually hear only after it stops. Watch the Korean won, the Canadian and New Zealand dollars. They're small enough to move, big enough to matter, and honest enough to confess when the dollar's shadow is getting long. This is why focusing only on a single dollar index can be misleading. What matters is the pattern. Multiple currencies rolling over together months in advance. Then official surprises. Then market reassessments. Then finally, the headlines that make the evening news. Why crypto bleeds when the dollar bites. And why that's not the end. Crypto Twitter loves a simple narrative. Money printer bad, number go up. But if you strip away the slogans and look at positioning, crypto has behaved like a high beta expression of tech risk for years. That's not an insult, it's a mirror. When dollar funding tightens, appetite for long duration, Story-rich risk compresses first. You see it in comps, in software multiples, in pre-profit dreams. So when the dollar pops, crypto's sell-off isn't proof it's dead. It's proof the buyer base depends on easy funding conditions, and those just tightened. The irony? That's exactly the environment where the original crypto pitch, credible neutrality, settlement finality, permissionless rails, should shine. But markets trade the assets they have, not the white papers they wish existed. But wait, didn't inflation just prove the debasement crowd right? Inflation proved that supply shocks and policy oversteers can light a fire under prices. It didn't prove that currencies must spiral to zero on a clock. After the spike, the system did what it always does: reprice, then retighten, then reassess. You saw it when the dollar strengthened, even as some price indices cooled. You saw it when soft landing narratives lived alongside very real stress in pockets of credit. If the debasement story were mechanically right, a stronger dollar simply wouldn't coexist with high deficits and big balance sheets. But it does, because the pipes decide. And right now, the pipes are telling you risk tolerance is wobbling. What to watch in the next few weeks, and how to interpret it. If the yen crosses lines that historically trigger Ministry of Finance action, I'm looking not just for a headline, but for persistence. Do we get a quick pop and fade, or a series of defenses that spend ammunition? If the rupee holds a suspiciously neat range while others slide, I assume intervention and ask what happens when the defense relaxes. If cross-currency basis widens and dollar funding spreads creep, that's not an academic alarm. That's a real-world tax on risk. If DXY and broader trade-weighted measures diverge, I care about the one pulling more currencies into its gravity, not the one making the cleaner chart. And if credit spreads, wake up while equities pretend nothing's wrong. I trust credit, because funding stress shows there first. The depression economics you can actually see. I don't use that phrase to be dramatic. I use it because the pattern repeats. Safe, liquid assets get bid. Anything that needs belief plus leverage gets tested. Banks tighten a bit, corporates delay a bit, consumers flinch a bit. None of those bits make headlines on day one, but they compound. You'll see it in weaker bid lists on new issues, in quietly wider high-yield concessions, in CFO language about flexibility and discipline. And you'll feel it when your brokerage app looks strangely calm one day and vindictively red the next. That jagged rhythm is what a dollar squeeze sounds like in price. Okay, so what do we do with this? My playbook. First, respect the signal. A stronger dollar is a market-based tightening. Treat it like 2 or 3 surprise hikes spread across the globe. If you're a business owner, check your dollar exposures. Supplier terms, import costs, any off-balance sheet FX assumptions. If you're an investor, shorten the time horizon of the risk you own. You don't have to sell everything. You have to own what you can fund psychologically and financially through volatility. Think in scenarios. If the dollar pulls back quickly, what rebounds most? If it persists, what bleeds slowest? Second, watch funding, not feelings. Positioning squeezes can create head fakes, but spreads and bases tell you when temporary turns trend. Third, keep dry powder near the front of the bench. In these tapes, opportunity shows up as forced sellers, not perfect narratives. Fourth, resist the urge to fight yesterday's war. If you were positioned for debasement and got paid, take the lesson. Themes change, plumbing doesn't. A quick word to the crypto faithful and the skeptics. You don't have to believe the euro-dollar thesis to see the behavior. When dollar funding tightens, crypto trades like the NASDAQ with extra caffeine. If you're building, keep building. Real utility doesn't care about FX day to day. But if you're trading, trade what is. Respect the dollar. Watch funding, not influencers. And remember, the goal isn't to be right on Twitter. It's to have capital when the market finally agrees with you. History's rhyme. Why this pattern repeats. Look back at the last decade's stress points, and you'll notice the same choreography. The dollar firms as overseas growth expectations soften. Temporary currency moves become policy headaches, risk rallies on every relief headline, and then ask silently for more dollars anyway. Eventually, you get a reset. Sometimes mild, sometimes not, and a new baseline that lets risk breathe. This doesn't mean doom. It means cycles. The dollar is the world's risk thermostat. When it spikes, the room gets cold. Pretending it's broken because deficits are high is like insisting it's summer in a snowstorm because your calendar says June. Dress for the weather you have, not the one you were promised. If this accelerates, here's what likely breaks first. You'll hear it in smaller, more open economies with dollar debt. You'll see it in commodity-linked balance sheets. You'll feel it in earnings guides that sneak FX headwinds into the third bullet point. You'll notice bid-ask spreads widen on the assets you swore were liquid. And you'll wonder why your favorite growth story can't catch a bounce. That's not karma, that's plumbing. If it fades, here's what I'll need to see. Stabilization in the yen without a parade of heavy official footprints. A rupee that trades like a market, not a straight edge. Cross-currency bases easing back toward calm. Credit spreads that lead equities higher, not hitch a ride after the fact. And most of all, a market that stops rewarding every scrap of safety and starts paying you for taking small, sane risks again. When those pieces line up, the dollar can relax without forcing a reckoning. Closing, the warning and the opportunity. The dollar is skyrocketing, and that is the problem. Not because it proves anyone's ideology, but because it tells you how tight the world's risk lungs are right now. You don't have to predict the exact top or bottom to survive this. You have to read the room, respect the plumbing, and keep your playbook simple. Fund what you own. Shorten the promises you make to your future self, and let the market hand you opportunities instead of chasing the ones your timeline loves. If this helped you see past the headlines, hit like so more people hear the warning before they learn it the hard way. Drop a comment with the one signal you're watching. I'll pin the smartest dashboards and do a follow-up breakdown on what they're saying in real time. Subscribe if you want the next step. How I map FX stress into concrete portfolio moves without pretending I have a crystal ball. Until then, protect your cash flow, protect your time horizon, and, above all, respect the dollar.